Well, I mean, first of all, what we see is a quicker normalization than market has initially assumed. I mean, the background of the drop is on the one hand side driven by much lower, about 30% lower gas prices. And the key driver here was less demand. So that's driven by a pretty warm winter, but also a declining demand in industry, or still a low demand in industry that hasn't recovered yet. So that's on gas prices. And secondly, CO2. So we have seen a strong decline in CO2 prices since the beginning of the year, above also around 30%. And both translate into a reduction of power prices of roughly 30%.
How can that be that CO2 prices are actually on the decline? Because if you look at what politicians want to do is to raise that price level as
Now, that's actually a good question. I mean, I would distinguish between two things. One is it's purely market driven. So with lower gas prices, you see more gas generation than coal generation. Therefore, the demand for coal is declining, and therefore also CO2 prices are coming down. And that is perfectly in line with the design of the CO2 regime that should incentivize switching from coal to gas. So that's pretty perfect. The issue, though, is that the EU Commission has introduced to finance the Repower EU program a mechanism which sells additional volumes of CO2 certificates into the market to finance 20 billion of additional funding. And what we see here is, on the one hand side, it provides additional volumes to the markets that lower prices. But secondly, that volume is not based on a number of certificates, but on an absolute amount. So if prices come down, it means they even need to put more certificates into the market than previously. And that is putting additional pressure on the market. And that is clearly something that is not the intention of the CO2 regime. And therefore, our request is clearly let the market work and also keep the stable condition of the markets and not intervene by just using it for budget purposes that are not related to the CO2 regime.
Let me bring you back to your operational business and also what you're planning to do with the funds you have available. So, of course, there are different possibilities, but one is, of course, as well, like other corporates are currently doing, to buy back shares. So is that something you would look into as well?
I mean, look, we just presented our strategy in November to the capital markets, and it was well received. And with that strategy, we clearly said that we want to see investments into renewables, transforming our business and growing our business. And by the time, we also said that we do clearly see that investments into renewables come with attractive returns, and that also, if we look at actual projects, we have met our return expectations. Having said that, the environment has changed, and we just talked about the decline in power prices. And it's very clear that such a changing environment also calls us as management to reevaluate the situation. That's why we communicated that we obviously always will revisit risk-return expectations and therefore also rediscuss potentially capital allocation. Yet, if I look at the numbers, I mean, we talked about declining power prices, but also in our plan, we already assumed that power prices would come down. Just the normalization came quicker than we initially estimated. And therefore, our long-term outlook for the time being hasn't changed. And that's why also we confirmed our earnings per share targets for 27 and for 2030.